Hey gang, it's Geoff Schmidt, and welcome to our teach-in live stream on the changes to Social Security. A couple of housekeeping items here. First, we had a power outage in our neighborhood about an hour ago, so we've just rebooted some of the equipment. One of the things that we had to change was the microphone, so if I sound a little bit different, I apologize in advance. We weren't able to reconnect the high-tech microphone to the live stream, but hopefully this will be good for you anyway. Joining me is Jill, our producer. She's going to be going through a lot of the questions that are coming in as we go through the live stream. Now, just a couple of housekeeping items. The quick disclaimer that we read at the beginning of every single live stream. We're going to cover a lot of detail tonight, and I haven't had the opportunity to interview you, so take this information as educational, and that's something you can rely on for your specific situation. As I always, speak to a qualified professional who's had the opportunity to interview you before making any decisions. The full disclaimer, by the way, if you'd like to read it, is in the description below, and that applies to the live stream. Also, I've put a download to a free giveaway in the URL, and that is my new Social Security quick guide. And you can see that right here. That is my free gift to you. It's a very concise one-page summary of a lot of the things we're going to be talking about tonight, and a lot of the things we aren't going to be talking about tonight. So you just go to holyschmidt.com/quick guide, and you can download it and get it instantly. All right, that's a bit about it for the housekeeping. So why don't we start running through this? Now, this is my first time with a teach-in, and fortunately, there's only one time per year that there's a change to Social Security, so you probably won't see a lot of teach-ins from me. But we're going to go right into point number one, which is the cost of living adjustment. Now, the cost of living adjustment went from 2.5% in 2025 to 2.8% in 2026. Now, on the one hand, that's a good thing because inflation was below what most financial planners use for their software, which is 3%. But on the other, it's moving in the wrong direction. And to compound that, with a lot of people feel like that doesn't really apply to them. They have had a situation in their lives, their economics are a lot different. They're not seeing 2.8%. In fact, when I mentioned this in a previous live stream, somebody said 2.8%, it feels more like 5% to me or more. And there's some validity to that. And the reason is because people don't spend like the basket, which is used to construct the cost of living adjustment. So when you think about what the COLA adjustment is, it's really just the consumer price index, and there are about 200 or 300 items in a basket that they watch the prices on every year, and that changes from year to year. So unless you spend specifically like that basket, then you're going to find that your reality is going to be different than 2.8%. And a good example is Medicare Part B. Medicare Part B. That premium will be announced shortly for 2026, and I'm pretty confident it's going to be a lot more than 2.8%. And that's deducted right from your Social Security check. And frankly, the Medicare Part B premium has gone up faster than Social Security for many years. And sometimes it doesn't, but oftentimes it does. And so that people are looking at that and they're saying, wait a minute, my Social Security payment went up $60. My Medicare Part B premium went up $30. That's half of the increase, but yet it's not half of the cost. And the reason is because they move at different rates. Even though they both are a byproduct of FICA, the reality is medical inflation moves faster, at least lately, than regular inflation. And so that's a very important point. The other point is that there's been a lot of media about Medicare lately. The Wall Street Journal published I don't want to call it an expose, but it was a fairly pointed article a couple of weeks ago on the fact that 1.2 million people were losing their Medicare Advantage plan, and their insurance company was just canceling them. So, by the way, if you find yourself in that situation, you should talk to our partner chapter about your specific situation. I'll put their information up so that you have it. It's there on the right-hand side. Give them a call at 440-703-1224. And even if you don't find yourself in that situation, we recommend that you talk to them anyway. They're very easy to work with. They'll spend about 20 minutes with you to make sure that you're on the right plan. And if you're not, they'll let you know. And if you are, they'll let you know. It's totally free to you. They save their clients an average of $1,100 per year, and they have access to basically all plans nationwide. So if that's of interest to you, give them a call, 440-703-1224. Why don't I pause here and check with Jill to see if there are any questions that have come through on the chat box. If not, we can move on to the next one.
Well, we have one question that has come in from Phil. Phil is from Renoki, and he says, I am eligible for full retirement December 2025. Will I get more of a benefit if I wait until January 2026?
Once you reach full retirement age, Phil, it depends on what you mean by benefit. If you're talking about a payment increase, your payment doesn't increase annually, it increases monthly. And because you have I'm assuming you are the primary insured, you're the one who's working, and the Social Security is based off of your specific earnings. And so you can actually continue to increase your earnings, and they increase at a much more quick rate once you hit full retirement age, between ages 67 and age 70. And those are recalculated monthly. So if you want to wait a month, your payment will be a little bit higher.
All right, great. And Scott has a question as well. Are there any raises to benefit estimates at the age of 60 and 61?
So I think Scott, I think the question you're asking, because of those specific numbers you're talking about, 60 and 61, you're talking about what happens to the calculation of your Social Security payment based on your previous work history. And the answer is, if that's the question you're asking, the answer is no. At age 60 and 61, your previous work history uses a 1.0 multiplier. And we're going to get into this in a little bit more detail a little bit later. But basically, for those of you who are wondering how your Social Security payment is calculated, the SSA takes your best 35 years and brings them into today's dollars. Well, how do they do that? If you earn, say, $20,000 in 1983, well, they'll take that number and they'll multiply it times something. And in 1983, it might be 3.6. So that would be $72,000 in today's dollars. As you get closer and closer to age 60, that number becomes lower and lower. And by the time you hit age 60, they only multiply times 1.0. So everything from age 60 forward is multiplied times 1.0. And that applies whether you take Social Security at age 62, at age 67, or at age 70. It's always multiplied times 1.0. The difference, though, is that at age 62, your Social Security payment, whether you've drawn it or you've deferred it, starts to increase with a cost of living adjustment. And so it's a different multiplier. So the true 1.0 effect is only at age 60 and 61.
All right, good. So then we have a question from John from Massachusetts.
Hi, John.
With Social Security due to run out of money by 2034, are we better to start taking money now that I am 62, or wait until 67 / full retirement age is 70 for us? We have 1.5 mil in 401k.
That's a great savings. So well done on that. So this is the question that comes up once a live stream, and it comes up in different ways. And I try to be non-political about this because it would be very easy to get political about this in either side, Democrats, Republicans. And by the way, Democrats and Republicans both feel that Social Security is sacrosanct. In other words, both parties want to save Social Security. They want to make sure that it is fully supported. So I'm telling you that because there isn't an elected official that I know of out there that would say, you know what, we're going to let this happen and good riddance. And I'm telling you that because I need to take you back in time to 1983 because the Social Security Trust was 2 months from running out of funds, 2 months. And in 1983, the Social Securities Act of 1983 was enacted. That did two things. It raised the FICA, Social Security portion of FICA from 5.4% to 6.2%. That solved the immediate problem. And then it raised full retirement age from 65 to 67, but starting in 20 years. So 20 years forward, it would start to slowly creep up by 2 months per year, so 2003. So what that means is that I think it's highly unlikely that a politician would let this happen. You can never promise anything like that because you just don't know. But there have been the big amendment, big amendments to the Social Security Act were in 1983, and then again in 1993 with a 94, 95 enactment. But there have been a total of 12 amendments, significant amendments to the Social Security Act. Maybe it's 13. And I don't really think that any politician would let that happen. My guess, if you want me to give you a crystal ball guess of what's going to happen, is that as we get closer and closer to that date, whether it's 2033 or 2034, the politicians that are in power at the time will enact something similar, where there will be some sort of modest increase to the Social Security payment by the workforce, and there will be some increase to the full retirement age, but it will be similar in that it won't be someone who's reaching full retirement age in 2033 to 2034. It might be 2054, 2044. The point is that nobody wants to spring this on the population of Social Security recipients, especially since there are at least 57 million of them that have a vote. And if their politician votes to not fix the problem or refuses to vote, well, that politician won't be in power anymore, would be my guess.
All right, good. Brian is asking, isn't the multiplier, oh, the screen just moved, figured by the year you turn 62?
It's calculated at 62, but it's retroactive. So when you turn 62, they go back to years, let's just say you started working at 18 through 59. And they determine what those multipliers are, but they give 60 and 61 a 1.0.
Okay. Do you know of any changes to SSDI?
Well, this live stream is about the changes to the Social Security retirement benefits. Social Security disability insurance is a different live stream, and we'll handle that on a different one. But tonight, unfortunately, we need to focus in on Social Security retirement income.
Okay, thank you for that. And Mega Rose is asking, if you keep working past 70 and I started getting Social Security at 65 years old, do they continue to add after 70 years old?
They continue to add to your Social Security. They take your best 35 years regardless of when you earn them. The difference is that you only get a 1.0 multiplier from age 60 onward. And Jill, I think we kind of need to move to the next topic, if you don't mind, simply because we got a lot to get through.
Yes, absolutely. Good place to pause.
So why don't we talk about the next change, which is full retirement age. Now, we talked about full retirement age and in a little bit earlier, but 2026 is the year that they stop increasing full retirement age. In 2026, if you reach full retirement age, you will reach full retirement age at age 67. If it was 2025, it would be 66 years and 10 months, 2024, 66 years and 8 months, and so on. Now, on the surface, this doesn't seem like a big deal, except for there are a lot of things that are tied to full retirement age. One of those is, of course, you get 100% of your Social Security payment. The other is that you can work as much as you want, and you don't have to give back any of the money that you earn from your job to Social Security. And we'll talk about the earnings test next. But until you reach full retirement age, you can only earn so much before starting to return some of that back to the FSA. So full retirement, and there are 3 or 4 what I call magic benefits, but the biggies are that's when you get 100% of your payment. A lot of the reporting from the Social Security Administration is assuming that you reach full retirement age. So when somebody gives you your spousal benefit, it's 50%, a maximum of 50% of the full retirement age benefit of the primary insured, and so forth and so on. There are about a half a dozen numbers that are all reported based on full retirement age. So it's an important data point, and it is in 2026, it's going to be age 67, and it should be age 67 for the foreseeable future. I'll pause here and see if there are any questions about this before we move on, or any questions at all.
Yes, there's one more here, a few more. ST says, referencing to the listener who asked, does the age that you take Social Security make a difference if you have a $1.5 million retirement portfolio? If we have a large portfolio, does it pay to wait until, until full retirement age?
I actually have a video on this, and the video made, so the answer is it depends. And this goes back to that big disclaimer I read to you in the beginning. It depends on things like your portfolio performance, your tolerance for risk, your ability to finance your life with something else besides your investments. Because if you are, for example, if you have a $1.5 million portfolio and you're holding off collecting Social Security, but you're drawing down on your portfolio, well, that might work depending on how much you're taking out from your portfolio. But if you're taking out more than your increase in Social Security, it starts to look unappealing. But unfortunately, this is a case-by-case basis. The one thing I will tell you is that if you go the other way and you take Social Security early so that you can fund your retirement portfolio, and this is a pretty common question, which is, should I take Social Security early, use that to invest in my portfolio, and isn't that better than the growth that you get by waiting? The question I always ask is, how are you going to finance your life? Because if you're going to be taking money out of your 401k to live and then taking Social Security and depositing it into your 401k or your IRA, I suspect is a better way to describe it, then you're just robbing Peter to pay Paul, so to speak. But if you have a pension, or if you have rental income from property, or if you have other income coming in, then it might make sense. But it depends on your specific situation.
Okay, great. Fast Eddie is asking, if women live on average 3 years longer than men, why don't they make women wait until 64 years old to start collecting? This way, men and women get the same amount. 60% of people collect Social Security woman. 60.
Well, I wish I had an answer for you on that one, Fast Eddie. I think that's just the one of those life's big questions that nobody's going to really be able to answer.
All right. Jim is asking, my wife is 2 years younger than I am. We have similar wages. My plan is taking my Social Security 67. She will file for her spousal benefits at that time and turn on her Social Security after 67. Jim, is there a question? Or I think that might just be a comment. Is there something you want to comment on that?
I think Jim's asking, should his wife take the spousal benefit and then switch to her own Social Security when she turns 70? That's what I was forecasting the end of the question to be. And I have a video on dual income households, and actually I recorded it about a month and a half ago. Go in and check it out. But every Social Security payment is, when you have a spouse who is both a primary earner on their own Social Security and they qualify for a spousal benefit, there's a concept called dual entitlement. And dual entitlement basically says that when you file for Social Security and you have your own benefit and you have a spousal benefit, you're deemed to have taken the higher benefit. Now, in order to qualify for a spousal benefit, your partner has to have filed for their own Social Security. That's a requirement before the spousal benefit becomes available. So there are some circumstances where the partner doesn't take their Social Security and the spousal benefit isn't available. But in that instance, you're probably going to be faced with a dual entitlement issue. If not, then the SSA will lock in a portion of that your partner's full Social Security payment at age 67, basically based on what they were taking on the spousal benefit, and then the balance will grow. But you're not going to get the full benefit of waiting to age 70.
Okay, and his follow-up question was, does this look like a good plan?
So I think I just answered your question, and so it isn't really. I think you're going to be faced with dual entitlement issues, but check out the video that I put out about a month and a half ago on two spousal incomes inside one family.
Okay, great. So Victor is asking, what if you stop working at 62 years old, but do not start drawing Social Security until 67 or even 70? Will those years of non-work negatively affect the amount of my monthly benefit?
Probably less than you think, although it would depend. You have to understand that you're going to get the best 35 years of your work history. So if you don't have 35 years of work history to begin with, there's going to be an effect. But every year that you don't work is 1/35 of the payment. But if you're going to be working, say, part-time from age 62 to age 67, it wouldn't qualify as one of your best 35 years anyway. It won't change the outcome on your payment. What changes your payment the most is the benefit for waiting. So if you think about what that means from, say, 62 to age 70, or age 62 to age 67, you get 70% of your full retirement age benefit at age 62. You get 75% at age 63, 80% at age 64, 86.66% at age 65, 93.33% at age 66, and 100% at age 67. And then it goes up 8% per year after that. Those are big jumps. So every one of those is a lot more than 1/35. The only point I would make here is that if you somehow got the job of a lifetime and you could earn the maximum for the year, the maximum contribution for the year, and in 2026, that's $184,500. Then you're going to be contributing quite a bit more to your Social Security payment. Most people don't see a significant difference if you're talking about a few years. And so you kind of need to see what's rolling off and what you'd be replacing it with, because it's your best 35 years.
Okay, and so he came back with, I have 45 years of full-time work history, and the Social Security website is showing I'll get the maximum benefit. I just don't want the non-working years to negatively affect it.
Without knowing your work history, this is an educated guess, and that educated guess is you probably won't see a big difference by not working because of that amount of work history.
Okay. Do we have time for another one before you move
We
forward?
do, because we've gone through 2 of the 5 points. So
Okay, so I have another one here from Geoff McCauley. He says, I turned 67 in December and intend to begin taking Social Security in January. My wife won't reach her full retirement age until May of 2027. Should we wait until she reaches her full retirement age before claiming her spousal benefit?
So her spousal benefit is not based on when you claim Social Security. It's based on when she claims the spousal benefit. And so you could claim Social Security at age 62, and if she waited to claim Social Security until her own full retirement age, she would get 50% of what you would have gotten at full retirement age. So the answer is, if you understand the mechanics, then it really comes down to, does she want to wait and get 50% of what you would get at age 67 or your full retirement age, or does she not? For the spousal benefit, at age 62, the spouse receives 32.5% of your full retirement age benefit, no matter when you file for your Social Security. You just have to have filed before she can claim the spousal benefit. At age 63, it is 35%. At age 64, it's 37.5%. At age 65, it's 41.86%. 66, 45.83%. And age 60 and beyond, it's 50%. It's entirely based on when she files for the spousal benefit. The only cardinal rule here is that she can't go until you go. You have to go first.
Okay, great. And I just want to mention to Maria, thank you for your Medicare question. And we will be hosting a live on Tuesday where Ari Parker, the CEO of Chapter, will be here, and we'll be taking a lot of those Medicare questions. And so I'm going to put this question aside to bring that for Ari. So please join us on Tuesday, and we'll make sure to bring this question up.
Great. Okay. The next change to Social Security is that the earnings test has gone up. Now, the earnings test is a provision in Social Security that says you can only earn so much, and if you earn more than that, then the SSA is going to take back part of what they've given you. In 2023, the earnings test was $23,400 for any year except for your full retirement age year. In 2024, it's $24,480. And what does that mean? It means that you can earn up to $24,480 in 2026, and you don't have to give any of your funds back to the SSA. For every $2 beyond that, you have to give $1 back. So it is a significant threshold. It's actually, most people, if they're planning on working, it's a problem, because most people who are working while they're in retirement, unless they understand they can only earn so much, violate this threshold. So they end up writing a big check. And if you find yourself in this situation, then the best thing to do is to notify the SSA and ask them to withhold part or all of your Social Security payment, because eventually it catches up to you. And because the SSA and the IRS do talk, they're brother and sister organizations, of course, they have all the same data, more or less. And eventually they will send you a bill for the difference. Now, a question, and then we'll talk about what happens at your full retirement age in a moment, or your full retirement age year in a moment. But just remember to turn it off if you're going to be working beyond that limit. In your full retirement age year, then you can earn up to, in 2026, you can earn up to $65,160, and then you have to give $1 back for every $3 over the limit. So the earnings limit goes up significantly. And once you reach full retirement age, that magic age that we talked about earlier, you can earn as much as you want, and you don't have to give any of it back to the Social Security Administration. Now, what happens to the money that you give back? Do they just keep it? No, that would not be fair. What they do is they basically credit your Social Security account, if you want to call it that, for the amount that they didn't pay you, and they recalculate your payment. And starting at full retirement age, you have a higher payment. So you don't lose it, but it's easier, I would say, to just tell them to not pay you than to have to write a big check at some point in the future.
Okay, great. People are writing in. Rob and Victor both agree your video on taking Social Security early was excellent.
No, thank you.
Thank you on that. Okay, Sedester is asking, as each year's statement increases due to more wages and COLA, is there a typical rate to estimate if I'm 12 years away from retirement?
So if you're 12 years away from retirement, the estimates, there will be an estimate on the SSA website. I don't think it's going to be super accurate. It'll be directionally correct. It's going to make some assumptions about your income, that it is about what it is now. It's going to make some assumptions about the number of years you're going to work all the way up through age 67. So the estimates make some assumptions that aren't necessarily correct. My strong view on this particular point is that you should be able to calculate your own Social Security payment. Believe it or not, it's not hard, but it's time consuming. And I have a course called Social Security Simplified, which actually walks you through how to do it. And if you're interested, go to holyschmidt.com/social security, and there you'll get a description on how it's calculated, and a lot of examples on this particular point. By the way, if this is of interest to you, or because this is Social Security month, we're giving $60 off the course until tomorrow night. So check it out, holyschmidt.com/social security. But regardless, you calculating your own Social Security payment really isn't that hard. It just takes some time.
All right, great. Terry's asking, is the earning test for the individual or the couple's income?
It's for the individual. And so your partner could make $1 million a year, and that won't disturb your earnings test. Your earnings test is based on the individual, whether it's their income from work or income from self-employment. It's not income from investments. It's not income from your 401k or your IRA or any other aspect. It's just from work or self-employment.
Okay, John is asking, can you walk us through taxes on Social Security? I expect to pay taxes due to multiple streams of income.
I can. I think what I'm going to do, John, is I'm going to give you some numbers, and then we'll take this one offline by email. Send me your specific situation to livestream@holyschmidt.com if this doesn't answer your question. If you're single, the SSA will not tax. If you're single, or you're married, there's a concept called combined income. And combined income is basically 1/2 of your Social Security payment plus your adjusted gross income plus your tax-free income. You add all that up together and you get a number. Now, if that number if you're single, if it's less than $25,000, you're not going to pay tax on your Social Security payment. If If it's between $25,000 and $34,000, you could pay up to 50%, or up to 50% of your Social Security payment could be taxable. That doesn't mean you're paying 50% tax. It means it could be taxable. And over 34,000 up to 85% could be taxable. But again, that's not your tax. Now, let me give you the married number, and then if you still have questions on this, let me know. But if you are married, and this is for the couple, if your combined income is less than $32,000, you don't pay tax on your Social Security payment. Between 32 and 44,000, up to 50% of your Social Security payment is taxable, and over 44,000, up to 85% of your Social Security is taxable. Now, those thresholds, so that's me walking you through the thresholds. I will also tell you that even though you may have a number that is taxable in terms of your Social Security payment, there are things like mortgage deductions and standard deductions. There's now a 65 plus deduction that make it less likely that you're actually going to be paying taxes on your Social Security, even if you have an amount that could be taxable. So if you need more than that, shoot me an email at livestream@holyschmidt.com. I'll try to get back to you as soon as I can.
All right. Do you want to get to your next point as I gather more questions?
Sure. So the next point is the wage cap. For those of you who are big earners out there, the Social Security Administration stops taking Social Security taxes from your earnings at a certain point in time. That's called a wage cap. And that portion that they take from your earnings is 6.2%, and your employer pays an additional 6.2%. If you're self-employed, then it's 12.4%. You just pay both the employer and the employee amount. So it's a pretty significant number when you're talking about, especially if you're self-employed, and a lot of people who have really big income numbers are self-employed. In 2025, that cap was $176,100. In 2026, it's going up to $184,500. And so if you earn more than $184,500, congratulations, that puts you in something like the top 1%, but also you aren't going to be paying taxes on the Social Security tax on any amount above $184,500. Now, we're going to be talking about something else in just a moment called bend points, but the next question that comes up is, what happens if they take the cap off, or they have a donut calculation on Social Security? How does that change this? And I'll talk about that in just a moment, because right now, the way Social Security is arranged, the higher earners get less and less of what they contributed as they approach that cap. I'll stop here and see if there are any questions before we talk about bend points.
Okay. We have one from Ed. And please do keep putting your questions in because we will be able to take a bunch more before our time runs out. Ed is asking, plan to retire at the end of the year. I applied for Social Security early September, but was let go from my employer mid-September. I'm getting medical benefits for 1 year from company. After the year is up, can other Medicare plans after my company plan expires, or do I have to wait until the open enrollment? Oh, that's a Medicare question.
So you qualify for, I'm just going to answer this, and then we will deal with, because we'll deal with other Medicare questions on Tuesday. But from the time you qualify for Medicare, that's basically 3 months before you turn 65 to 3 months after you turn 65, and then the month you turn 65. There's a 7-month window where you should be applying for Medicare. And it sounds like you're at or around 65, but if you're approaching 65, that's your window. If you have a more detailed question than that, send it to livestream@holyschmidt.com and we'll answer it on Tuesday.
All right, great. So you can keep going.
Okay. So the last point we're going to talk about here tonight, and maybe we'll end early, who knows, but it's what are called bend points. Now, I said earlier that there is a wage cap. So you contribute up to a certain amount, and beyond that amount of earnings, you stop contributing. Your Social Security payment is based on how much you contribute. So there is an absolute maximum. You're not someone who earns $100 million a year. Their Social Security payment doesn't keep going up. It caps out at about whatever the payment would be in 2026 for $184,500. Now, what happens to that payment is that the SSA has what I call the great equalizer. And I should actually trademark this because I think it's such a wonderful term for this. The SSA looks at everybody's contributions, and they take that money, and let's just say that you were a huge earner. You made the equivalent of $184,500 per year going back to 1983. You qualify for the maximum total Social Security payment. Well, that amount is the SSA is going to take your top 35 years, bring it into today's dollars. They're going to index it to today's dollars. Like, remember we talked about earlier, your 1983 earnings might be multiplied times 3.6, whereas your 2025 earnings might be multiplied times 1. Well, they're going to do that with your best 35 years, and they're going to take that total and they're going to divide it by 420 months. Well, what's 420 months? That's 35 years. And they're going to give you one number. That one number is the starting point for actually what you're going to get paid at full retirement age. But they need to take that number and they need to do something with it. They're not just going to give you your historical earnings on a monthly basis. They have to reduce it, because if they didn't reduce it, it would be like winning the lottery. And so they take that one number and they feed it into a formula called bend points. And this is why it's called the great equalizer. Because let's just say that your number was $5,000 a month. Well, the bend point formula in 2026 says that of that $5,000, your Social Security payment, the first $1,286, you're going to get 90% of at full retirement age. And the amount between $1,286 and $5,000, you're going to get 32% of. And by the way, that 32% is actually up to $7,749. And anything above $7,749, you get 15%. So what ends up happening is if you're that big earner and you earn the maximum amount every year, you're going to earn, this is about the right math. You're going to contribute about 11 times more than the earner who just earned that $1,286 per month on average, but you're going to get approximately 3.2 times as much. And so it's a big difference. It's 3 times difference, but it's not 11 times difference. And that's because of bend points. These are the great equalizer. They take the big earnings and they reduce them by tiers. Tier 1, 90% of, in 2025, it was 90% of the first $1,226 per month. Then that 1,226 has gone to 1,286. So it's gone up $60. The second tier, 32% tier, has gone from $73.91 to $77.49, and anything, and that's 32%. Anything above 77.49 is 15% up to the cap. So what does that mean? It means that if you were halfway there, you probably wouldn't get a lot less than the person who earned up to the wage cap in terms of Social Security payment. It's not going to be half. It might be 3/4 or of what they get, or certainly more than half. So that's how bend points work. It's a very complicated formula, but just know that basically the purpose of bend points is to make sure that the people who didn't have a big earnings life don't get penalized for that. They get back basically 90% of everything that they earned on average up to $1,286. I think that's a good point to stop and see if we have any more questions. I know that we're coming up on 7:46, and I didn't really know how long this teaching was going to go, but I wanted to make sure that everybody had this information. So why don't we see if there are any more questions that need to be answered?
Okay, I want to make sure I didn't ask this one. I think this is where we left off. Phil is asking, if you defer applying for Social Security at full retirement age, how much does your Social Security payment go up per month?
So if you defer at full retirement age, now I'm going to answer this two different ways, because there's the deferral, which I think you're talking about, and there's the deferral, the little known secret that you might be talking about. If you don't take Social Security until age 70, it goes up every year, just as I described, and you get 100 from age 62 to age 67, goes from 70% to 100% at different steps. But then it goes up 8% per year beyond that. And so at age 70, you get 124% of what you would have gotten at full retirement age. If the question you're asking is, what is the deferral amount? It's 8%. You get 8% more per year from age 67 to 70, so you get 124%. If you're not asking that, but you're asking about that, the little known fact that a lot of people don't understand, let me explain what that is. When you claim Social Security, you have a period of time where you can change your mind. And that period of time is 12 months. Now, if you claim Social Security and you take Social Security and you change your mind within 12 months, you have to give what they've given you back, but you can undo it. But if beyond 12 months, you can't undo it. However, if you decide that you want to undo it at full retirement age, you can. So if you claim Social Security and you've taken Social Security up until full retirement age, then at full retirement age, you can say, you know what, I want to stop my payments and I want them to increase again up to age 70. The difference is the base is different. So let's just say that you decided at age 62 to take Social Security, and that's 70% of your full retirement age benefit. So you take you lock it in at 70% up until full retirement age, but then at full retirement age, you say, you know what, I want this to grow again, and so I want to let this grow from age 67 to age 70 because I've hit that magic number, that magic full retirement age of age 67. And one of the benefits is that you can again let your Social Security grow, but it's not growing at 8% per year. It's growing at 8% of 70% per year. So in that instance, if you let your Social Security payment grow for 3 years from 67 to 70, you would get 8 plus 8 plus 8. That's 24% more on 70%. I don't have a calculator in front of me. Actually, I do. So 70% times 1.24, you get 86.8% of your Social Security payment in that scenario. Taking it at age 70, drawing 70% of your Social Security payment, and then restarting or resuspending it at age taking it at age 62, letting it grow, or letting it pay you until age 67, and then suspending it until age 70, the number would be 86.8%.
All right. RW is asking, the Social Security Administration sends out an annual estimate for benefits based on one's history. My question is, do those estimates include estimated COLAs, or do those current estimates get adjusted later on?
They get adjusted later on. You can't. The estimated cost of living adjustment is, unfortunately, it's not something that people can predict, and so the numbers that you get assume that everything as it is today, and your earnings are approximately what they are today going forward.
All right, Sedester's asking, I'm a spreadsheet person. I've established current essential expenses and estimated future values based on 3% give or take over time. Can we establish an inflationary rate for Social Security the same way?
Well, I'll tell you how I would do it, but I'm not sure that you should do it this way. If you look back at Social Security historically, the increases have been somewhere between 2 and 3%. There have been outliers. Several years ago, it was over 8%, but it was between 2 and 3% for a lot of the time. And you can actually look back in history and see that the min max is around 2 to 3%. There might be a little bit more, might be a little bit less. So if you're trying to think about what the Social Security outcome will look like, I think you need to understand that the Federal Reserve Board's targeted inflation number is between 2 and 3%, and they managed that number. And so it's not a mystery why it ends up between 2 and 3%. The Fed will adjust interest rates to speed up or slow down inflation. They have only two functions. One is to hit a certain employment level. The other is to manage inflation. And so if inflation is out of control, they're going to raise interest rates and bring it back down to within that band. So if you're plugging a number into your spreadsheet, if I were plugging a number into my spreadsheet, I would look at it somewhere around 2 to 3%. But that's me, and I don't have a crystal ball as to what the cost of living adjustment will actually look like in the future. That's just using your spreadsheet example. That's just a way that you might want to consider it.
Okay. Ramsey is asking, does the Social Security calculation consider the total number of years I've contributed? I will have 22 years of contribution, not the full 35 years. So does that mean the Social Security calculation is wrong?
No. The SSA will take your best 35 years and divide that. They'll add it together and divide it by 420, and they'll feed that into the endpoint formula. If you don't have 35 years, they'll give you zeros for the years that you didn't have. And so if you end up with 22 years, that's a fairly significant haircut, but you have the great equalizer to help you with that, because again, you'll get 90% of the first $1,288, and then 32% of the next $7,749. So on the one hand, it is a pretty big reduction on the total available to divide by 420. On the other, that is the very reason that the endpoint formula is constructed the way that it is, for people that actually don't have the ability to generate a high number, either because they don't have the full 35 years or they had a modest income for 35 years.
Okay, great. So Victor is asking a question about Services. So does Mr. Schmidt offer services to analyze a person or a couple's social security projections and offer advice on what to do correctly to get the maximum benefit? And Victor, what I would tell you is Geoff right now is in the midst of developing many different products. At this time, he does not offer that. But do stay tuned. He will have many more courses coming out and a lot in store. So do stay tuned. Do you want to add anything to that?
So the course that I think everybody, I think everybody should take this course, and it took me a long time to develop it. It's called Social Security Simplified, and it's one that it was a labor of love. I just added to it. I updated it for 2026 a couple of days ago, and it is such a powerful course. We've got great feedback from the participants in this course, and hundreds and hundreds of people, maybe more now, have signed up for this course, and it just came out in August. And it is something I highly recommend. If you want to check it out, go to holyschmidt.com/social security, and $60 off until tomorrow night at midnight. So if you're looking to become proficient in Social Security, I use the tagline, go from beginner to confident in about 5 hours, because the course takes about 5 hours to complete. And virtually everybody I've talked to feels pretty confident coming out of that course that they know what to do.
So Victor responded and said, I agree about the course. Very good material and training. He already took it.
Oh,
so great on that one, right?
Way to go, Victor.
And lots of thank yous for this outstanding discussion coming in. A few comments about that there were some ads running, and so they missed a few things. And so I'm wondering if maybe with the 3 minutes left, if I know you had 4 points about the changes coming out for 2026, if maybe you want to just take a few minutes to do a little summary of them.
Yeah, so a couple of different things. For those that came late, the big changes were the cost of living adjustment, 2.8%, the full retirement age 67, the earnings cap of $184,500, and the earnings test has increased from in a non-full retirement age year from 23,400 to 24,480, a full retirement age year 62,160 to 65,160. I am going to give you a preview of something. I really shouldn't, but I'm going to do it anyway because I'm super excited about this. In about a week, I've been working on this diligently for the past month and a half, and that is I'm going to have a customized report, recommendations for you based on your specific situation. It's called the Retirement Ready Report. And you go in and you answer 15 questions, and it'll tell you, you're looking good here, you're not looking so good there, you really need to pay attention there. It'll be out in about a week. I promise you, I will find you on it because it's totally free. And I want to make sure that everybody gets the opportunity to take this quiz. It's a 15-question quiz, and then you'll get a report emailed to you within a couple of minutes. It's fantastic. Just I'm working out some technical issues, basically how to make sure that it sits on my website properly. But the report is done. It's awesome. And so check me on a live stream in a couple of weeks, and I'll tell you how to get it.
All right. And also just something else on the course for those considering taking that, and for Victor, who has already taken it, that you do have lifetime access to the course. And so any updates that are added in with changes and anything else, sometimes there's bonus supplemental material added. There will never be any other fees added to that. It will always remain, you get lifetime access in addition to all the add-ons.
Sorry to block out your face on this one, but this is the QR code if you're interested in it. holyschmidt.com/social security. Go from beginner to confident in 5 hours. Love that tagline. All right, let me put back up the other information, but if you're interested in the course, holyschmidt.com/social security. Just a couple of other points. This live stream really was making sure that you have the 2026 updates that you need. I have a free one-pager. Go to holyschmidt.com/quick guide, or you can just aim your phone right at that QR code and it'll take you right to the page to drop in your email address, and it'll be emailed to you instantly. Totally free, my gift to you. And I want to make sure that you have that. That is a very popular giveaway. It's been out a week, and we're just, I mean, it's going nuts. A lot of people are downloading it. And again, if you have questions about Medicare, we are in the annual enrollment period. We recommend that you talk to our trusted partner chapter. Their number is 440-703-1224. And I actually think we made it, even though we had some technical difficulties on the audio, power outages, etc. So we are. You can imagine how panicked I was when the power went out 30 minutes before the live stream, and everything was rebooting. The audio didn't reboot, so we're using a different audio. And so, but I do want to thank Jill for her masterful navigation of the questions and asking questions at just the right time so that we can actually get through the teach-in. And so thank you so much. In the description below right now is a link to 2 videos. One is a very concise video on the 5 changes to Social Security. So if you want to see even more, then when you're done here, go down to the description below. It's already there, and click on the link and you can watch the video. I think it's about 14 or 15 minutes. And the other is a discussion about what's happening with Medicare and the 1.2 million policies, 1.2 million individuals that have been canceled, and what you can do about it. Actually, they're both very powerful, very useful, and they're right in front of you. So go check them out, and I will see you, so to speak, on Tuesday. Jill, thanks again for all your help, and gang, thanks for staying up late with us on the teach-in. We'll see you next week.
Take care. A lot of thank yous, a lot of gratitude coming in. So great job.